In this video, we're going to look at Briscoe Group, which is a New Zealand retail chain. It has 84 stores in New Zealand, and it goes by the names Briscoe Homeware and Rebel Sport. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. And then I look at the financial ratios of the company and compare them with their competitors. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $710.2 million, and they're trading at $3.30. And everything in this video is in New Zealand dollars because this stock trades on the New Zealand Stock Exchange. Now I'm going to get to free cash flow. And free cash flow is the cash that's remaining after operating a business minus capital expenditures. And capital expenditures are buildings, machineries, equipment. And the way you value a company is you forecast the future free cash flows and discount that number back to today's value, which is what I'm doing in this video. Now I'm pulling the net income, which is a profit and loss according to the income statement. And then I'm going to pull the revenue, which are the sales. That's also on the income statement. And the numbers look pretty good so far. You just want consistent positive numbers, and that's exactly what they have. Let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. They pay $14 million of interest on their debt. They have $296 million of debt. So the interest rate they pay is 4.6%. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. The income before tax is $84 million, and the income tax is $21 million. So their effective tax rate is 26%, so the cost of debt is 3.4%. Now let's get the cost of equity. We need the beta for that. That's the volatility of the stock, and it's 0.54. So it's not volatile at all, the stock. It moves roughly half what the market moves. Let's go back to the balance sheet and get their current assets. We need this for when we calculate the current ratio later, and current assets are mainly cash, accounts receivables, and inventory. That's $164 million. We also need current liabilities to calculate the current ratio. These are debts and payables that are due within 12 months. That's $105 million. Let's get their stockholders' equity. That's assets minus liabilities. That's $312 million. And then we'll get their EBIT, earnings before interest and taxes. On the income statement, that's called operating income. That's $88 million. And now let's look at the capital structure of the company. The cost of debt is 3.4%, and they have 49% debt. The cost of equity is 6.5%, and they have 51% equity. So the weighted average cost of capital is 5%. That's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company for $1.2 billion. We divide that number by 215 million shares, and we get an intrinsic stock price of $5.63. It's trading at $3.30, so it's trading at a 41% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're at $4.82 per share, so they're also valuing the company at a buy. Let's look at the historical stock price. So it seems like the stock was trading about $4.50 3 years ago and a few months ago, but it's dropped and went below 3, but it's come up a little bit. Seems like a pretty safe stock. The company seems solid. They have good financials. Let's look at the financial ratios to see if we get more information. Really good PE, 11.3. That's price of stock, which is $3.30, over earnings per share, 29 cents. To get earnings per share, it's net income, 63 million, over shares outstanding, 215 million, which is 29 cents. That indicates investors are willing to pay $11 for $1 of earnings. If a PE is below 15, that's considered a good value. Price to sales ratio 1.1, that's also a really good number. That's price to stock 330 over sales per share 303. To get sales per share, it's revenue 653 million over shares outstanding. So that indicates investors are willing to pay $1.10 for $1 of sales. So that's a really good ratio. I like to see below 2.5. Price to book is also really good at 2.3. That's price to stock over book value per share. And to get that ratio is just stock price over book value. And book value is $1.45. To calculate it, it's equity. And the equity is on the balance sheet. Assets minus liabilities equals equity. That's 312 million divided by shares outstanding, $1.45. So they're providing really good value according to their ratios. They have a good current ratio, 1.6. That's current assets, 164 million over current liabilities, 105 million. So they can cover their current liabilities. They have good ROE. I like to see 20% or higher, and they're 20%. That's net income, 63 million over equity, 312 million, 20%. They have a good interest coverage ratio, 6.4. That's EBIT, 88 million, earnings before interest and taxes, over interest expense. So they can cover their interest expense more than 6 times. That's a good sign. The best way to look at ratios is to compare them to similar companies. I've done videos on Macy's and Kohl's, which is in the same industry as Briscoe. And although they're in different countries, you could still compare all the ratios. It's just a market cap is in the home country's currency. So in terms of PE, Briscoe is worse than the average. Even though they have a good PE, you should always compare it to competitors. They're worse than the average in price to sales and price to book. So even though those ratios look really good, it's not as good as Kohl's and Macy's. Current ratio of 1.6, so they're better than the average in current ratio. They have the best ROE, which is a good ratio to have. They have the most debt of the 3 companies, and they're by far the smallest. I converted their market cap to US dollars, and they have $469 million market cap, compared to Kohl's and Macy's, which are billion-dollar companies. So it's really interesting looking at companies from different countries and comparing them. Let me know if you have any other tickers from different countries that you want me to look at. Thanks for watching the video.